Hey option traders, for today's trade we're looking at another covered call strategy. Last week we dove into a covered call in Starbucks, but this week we're turning our attention over to Johnson & Johnson. So looking at J&J on MarketSmith. After breaking out in mid-March from a 173.72 double bottom entry, shares briefly became extended before rolling over back to the buy point after a few positive trading days. This week, though, the stock has regained its 50-day line and is trading near the top of its current buy zone. The stock's RS line is also showing no signs of a correction. Shares of Johnson & Johnson are part of the Medical Diversified Industry Group, which ranks number 34 out of IBD's 197 groups. Reported Q1 earnings and delivered a 5% revenue increase to $23.4 billion, while earnings of $2.67 a share rose 3% year over year. So with the stock below key levels of support, you could consider putting on an income-generating trade here known as a covered call. A covered call is a simple strategy that is designed to collect income while also defining predetermined exit price at which you'd sell the stock, thereby partly offsetting the decline. So let's say you buy 100 shares of stock. Covered calls can also allow you to lower the cost basis of the position by selling options. So to refresh, a call option here is a contract between a buyer and a seller to purchase a specific stock at an agreed upon price known as the strike price up until a defined expiration date. So remember, with options, there are two types of options. There are calls and then there are puts, and you can either be a buyer or a seller of either one. You can, just like with the stock, buy long or sell short. So you just simply need to first buy the shares of stock, then become a seller of call options on that stock, collecting income to offset the cost basis. So basically, you're obligated to hand over your shares of stock to the call buyer at the agreed upon price, strike price, if shares trade above this price at the expiration date. And in exchange for this, the buyer of the contract pays you a premium. Any appreciation in the stock above that strike price represents a profit for them, for the buyer. But if the stock instead declines in value, the buyer would have no reason to exercise the right to buy it for a higher cost. In this case, they'd likely just allow the contract to expire and lose the premium paid. Depending on the option, you could have a number of different expiration dates and strike prices to choose from. This, incidentally, is one of the strengths of options, providing you with choices. So investors can analyze a variety of criteria to determine which best fits the needs of their portfolio. Investors must understand that time can be a double-edged sword, especially for buyers. Options contracts decrease in value at an accelerating rate as they get closer to the expiration date. If you're considering putting on a covered call in a given stock, you should first do the following. Ask, do I believe this stock will trade in a neutral to bullish direction, and am I willing to own this stock even if the price falls a little? And if the answer is yes to both of those, then it may be okay for you to proceed with this trade. Covered call writing is not simply a buy and hold strategy. It involves thinking ahead about appropriate action and possible future scenarios. So for example, if the stock price declines, where will you sell and take a loss? The covered call seller bears the risk of any price declines in the underlying stock. If you purchased the stock, say at $43 a share, but collected $1 in premium from selling a call option, you'd reduce your break-even point on the stock to $42 a share. And if that continues to fall below the price, it may be a better idea just to close out the trade early. So now that you have an idea, or better idea of covered calls, let's take a look at my trading platform and set up this trade here on Johnson & Johnson. Here's how to set up this trade on your option platform. First, type in J&J, which is the ticker symbol for Johnson & Johnson. And on Thinkorswim, just select covered stock in the spread type here. It'll make setting up this trade a little easier. You're going to want to make sure you have the June 17th options expiration date selected. And we're going to be looking at stocks with the 182.50 strike price right here. And to reiterate, first we are looking to buy 100 shares of J&J stock outright, and then sell 1 J&J call option contract with a 182.5 strike and a June 17th expiration date. We're interested in buying 100 shares of J&J first, which would cost around $18,165. Then in a 182.50 strike expiring in June would generate around $300 per premium income. Selling the call option generates an income of 1.7% in just under 1 month. That's on top of the 2.4% annual dividend yield you'd collect for owning the stock. On an annualized basis, the investor would be earning over 26% with this trade. If shares close above 182.50 on the expiration date, the stock will be called away at 182.50, leaving you with a total profit of $385, which is the gain on shares plus the $300 option premium. That rounds out to 2.2% return or 34% on an annualized basis. Of course, the risk with the trade is that the stock might drop, which could wipe out any gains made from selling the call. As always, remember that if you're new to options, make sure you practice with a virtual trading account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.